Have you opened your own investing account, but you haven't actually invested in anything? If you don't know where to start, in this video, we're going to break down some things you need to think about when you're setting up your first investment portfolio. I'm Afro Senpai, and I'm interested in everything related to the average person like you and me building wealth. Let's go. Before we begin, I gotta say this as a caveat. Even though I have the disclaimer in the beginning, whatever I'm about to say is not financial advice, even though it may sound like, hey, you should invest in this. I'm gonna start my sentence with, you should think about, meaning always do your own due diligence, because I'm not your financial advisor, nor am I a financial advisor. I'm just an average person trying to be the first millionaire in my family. So having said that, let's begin. Now, we're going to break this down into a couple of different tiers. So this is the, I don't want to look at this until 50 years from now sort of scenario. So if you're in that boat where you want to set it and forget it, you don't want to be bothered by looking at prices, blah, 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 think about investing in VOO. It's a collection of the best stocks that we have to offer in our country. And you may be saying, 100% in VOO, don't I need multiple things? Like I said, VOO is comprised of a bunch of the best stocks that we have to offer. VOO is known as an ETF, an exchange traded fund, which is a fancy word for a group of stocks as opposed to buying all the stocks in the fund individually. VOO is also an index fund, which means its main job is just to copy an index. And an index is just a specific group. Could be a sector, could be a subsector. In this case, the S&P 500, the best 500 companies we have. Another thing to keep in mind about ETFs is that all ETFs, because it's a group of stocks, they will have an expense ratio. An expense ratio is basically a fee for compiling all these stocks together for you. And this particular expense ratio is around 0.05%, which is a great expense ratio for a market fund. We know that market funds typically return about 10% annually to investors. So VOO does the dirty work for you and only takes a little slice as a thank you. Gotta let the cat in.
Get your butt inside.
Now, let's say you don't like 10% and you're okay with a little bit of risk. You might want to look at MGK. It's a fund comprised of large cap stocks. And when I say large cap, I just mean they have a lot of money in them. So be thinking of Apple, Amazon, Google, Microsoft. And let's say you don't want to do anything, but you're okay with risk. Maybe you're in your 20s. You're going to have a lot of time for the market to go up and down and blah, blah, blah. You should check out VGT. VGT is all tech stocks. And we know historically that tech stocks outperform the market. So you have the market with VOO, you have tech stocks with VGT, a nice middle ground for you if you're in your 40s or 50s might be MGK if you're trying to play catch up. But let's say you want to be an investing bro and you like to look at financial markets, you like to see the stock market move up and down, you might want to think about doing a mix, 50% MGK and 50% individual stocks of things that you love or things that you've researched. And at the end of each year, you can kind of compare how your individual picks did versus an MGK, or maybe you go 50% VOO to have a strong foundation and then 50% your own individual stocks. Just don't get high on your own supply. If the individual stocks that you picked, they blew up 23%, 40%, and you said, I don't need these ETFs. They're weighing my portfolio down. Always have a strong foundation that you know that you don't even have to look at because it's going to do well. And again, if you're young, if you're really money hungry, you can think about 50% VGT, 50% individual stocks. Now, some people might be asking, what about value stocks? What about dividend stocks? And while value stocks and dividend stocks are great to think about in the long term, dividend stocks meaning companies will pay you money for owning the stocks. Think of interest in a bank. When you're just starting out a portfolio, having 2 shares of Apple isn't going to yield you a lot in dividends, and you're waiting for these value stocks to pop off even though you're trying to grow your wealth. And that's not what value stocks are for. Value stocks are what it sounds like. Value stocks are your slow and steady companies. They're not going to have big blow up situations. So what I do is I grow my accounts, let them blow up over time, and then when I'm getting closer to retirement, I'm going to be shifting into value stocks or dividend paying stocks. Unless you're talking about yield max ETFs, which is a different video. So if you just graduated high school or you're in college and you're getting into the investment game, think about those growth stocks or those growth ETFs so you can blow your money up. And then once you start to have a family, you have more responsibilities, start to transition into safer value type portfolios where you're not going to get wrecked. So we did a lot of talking about ETFs. If you want to check on ETFs, their performance, their expense ratios, yada, 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 check out etfdb.com. There you're going to be able to see important information on the ETF in question, as like the expense ratio, the performance over time, and at least the top 10 holdings. Another thing that I like to do is look at how my portfolio will do in relation to a new idea that I have or a new combination of stocks that I'm thinking about investing in. And I do that with Portfolio Visualizer. Here you can input the different stocks or funds that you would want to invest in, switch up the allocations, and then run a scenario in years to see which portfolio would have done better. Now, if you have a fund that just came out, you're not going to be able to make a very good comparison. But if you're playing around with stocks that have been here for a while, you'll be good to go. And one more point I like to make about expense ratios. I already said that market funds have expense ratios in the 0.05 range. Now, there are funds that have higher expense ratios, and I'm only getting into a fund like that if they can offer me a great return on my investment. So if we know that the market fund returns 10% and its expense ratio is 0.05, and I find a fund that's expected to return 40% and its expense ratio is like 0.39, I'm okay with having that higher expense ratio if I know it's quite likely I'm going to get a higher return. So some things to think about. So whether you're in a brokerage account or an IRA, you gotta invest in something. Don't be in that boat where you send money to your account and then you're looking at it months, years later, and you're like, why hasn't this money done anything? Some people have put money into their accounts and not actually invested in anything. Let me know in the comments, how upset would you feel if somebody was looking at your account and said, bro, you didn't invest? It's a kick in the balls, right? So we're going to avoid all that and set up a nice portfolio. And that's going to do it for this episode. If you have any questions, leave them in the comments below. I'll get back to you. If you appreciate the value that I drop, feel free to subscribe to the channel. Don't forget to pay that like tax and share this with somebody who's in the same boat as you. You have the money, you have the accounts, you just don't know where to start. And until the next one, remember to smile because you are beautiful. Peace.